So this question relates to asset-backed loans and is a great question. And for those of you that don't know what an asset-backed loan is, it's a loan where you qualify for a mortgage where you don't use pay stubs, W-2s, tax returns, anything like that. Typically, it's for people that have a large amount of money. In many cases, they're self-employed. Maybe they just retired. Maybe they have some type of trust income. Maybe they have some type of royalties, something which is not a traditional structure in terms of qualifying for a mortgage. So all they do is they provide the assets for qualification purposes. How it would work is if you were borrowing, say, $1 million and you had a brokerage account of, let's say, $1.3 million, you would have more than 125% of what you're actually borrowing, and that's how you would qualify for the loan. What this question specifically refers to is pledging part of that brokerage account. And what that actually means is you have this $1.3 million account, but you went to your broker and said, hey, I need $400,000 or I needed $500,000, but I don't want to sell any stock to get it. So what the broker says to you is, no problem, we will give you that $400,000, but I need you to actually pledge $600,000 or $700,000. So you pledge more than you actually borrowed. And what that means is that portion of that account becomes restricted. You can do some trading, but it's very limited. So in this example where you had a brokerage account worth 1.3, if you say pledged 700,000, you would have $600,000 available to you, and that's what you would have to qualify for if you were doing an asset-backed loan. I am finding in some cases where people are actually getting cash out of their house, they're using part of the cash to pay the margin account off, so they release themselves from that pledge and they can qualify for the 1.3. And there has been a lot of that lately because a lot of people feel like we're going into a volatile market and they don't want to be caught in margin calls.